we'll be talking to Brenda Mitchell from Bank for Y. Welcome, Brenda. And I just wanted to do a little introduction to our audience. You know, I've known Brenda many years, and in the past 10 years, she's been one of the top 2 lenders here in Honolulu, and she's closed over $2 billion in loans. And also she specialized in mainly jumbo mortgages, which are mortgages over $765,000, and self-employed borrowers. And I know with our community of a lot of small businesses, she's a real asset to my business, to me personally, and to a lot of entrepreneurs out here in Honolulu. And welcome again. And before we go in and ask Brenda some questions this morning, I just want to put something out there. And the reason I brought Brenda here today is, you know, a big part of our financial freedom is having your heart and mind free from worrying about the what ifs in life. And I believe if we, you know, bring on specialists and give us the wisdom and take that knowledge and use it to where we want our lifetime goals. As everyone knows, I'm really into a lot of life planning and goals. And I hope after today, this will help your portfolio of real estate, or if you're thinking about buying. And so I'm going to start off with Brenda and ask you a few questions. You know, basically, you know, what are the trends you're seeing right now in the mortgage business?
The mortgage industry has been unbelievably busy lately. Although the world around us is really being affected by COVID-19, the rates themselves have really dropped because of it, because of the economic uncertainty, because of the, you know, just complete downslide of the economy in general. So our rates, our mortgage rates have been really low, which is a really nice thing for people who have the opportunity to refinance their mortgages and bring their rates down. And it's also wonderful for anyone looking to purchase a new home. It gives them a lot more buying power. And for us, especially for a 30-year loan, when you can do that at 2.875, it's an unbelievable opportunity for people.
How I know a lot of people out there sometimes went with a 5 or 7 year mortgage versus a 30-year mortgage. So how are those rates comparing right now to the 30-year fixed?
They're definitely lower, but because we're in such a great low interest rate environment, that's a kind of product that I would recommend to a client who is either doing an investment loan, who feels strongly that they won't need it more than 5 to 10 years. The longest arm that we have goes out 10 years. So it's a 30-year loan, but fixed only for the first 10 years. And the rates on that are as low as 2.625 today.
Right.
You can even lower on the 5 and 7 years. So they're a very amazing opportunity for people. But because the 30-year loans are based off a different index, those are falling more rapidly than the adjustable rate mortgages are. So you're seeing that variance between the products not be quite as severe as you may normally expect to find them. So really depending on what the overall plan is for a property. If someone's buying their absolute dream home, live in it forever type of home, a 30-year product just cannot be beat. Or if they're planning to keep it forever and rent it down the road, rather than, you know, having to refinance it down the road, being able to rent it out later on, having initially secured an owner-occupant rate on that is priceless.
And I suppose a question that we get often too is somebody owns property and they say, when do I consider refinancing? You know, if I'm getting this certain rate and this rate's today, what is the spread? When should someone consider refinancing an existing mortgage?
I don't think there's one blanket answer to that. I know that a lot of people come to me and say, you know, I heard you need a 1% change in your rate in order for it to make sense. And it depends on a lot of variables. One, depends on, most importantly, if you are simply refinancing just the balance, or if you have other debts that you could consolidate at that point and bring them in. And even if they're credit card debts, car loans, student loans, things that may have a higher monthly payment because they're amortized over a shorter period, spreading them over a 30-year period, especially in a tough economic environment like this, gives people a lot of freedom and really frees up a lot of cash flow, and is a great opportunity and a great way to use their equity. The other really important variable is how large your loan is. The larger your loan is, the bigger variance there will be in your payment just by moving it down even half a point. So each case, I think it's a little bit case by case. If you're within 0.25% or 3/8, even sometimes a half on a loan that's in the conforming space around 765 or less, it's probably not going to be as worthwhile. But if you have a million and a half loan, even lowering it that 3/8 in rate could be considerable. A lot of people also took home equity loans out on their properties to either purchase it initially and now they have more equity, or to do home improvements. And those rates, although they have great teaser rates in the beginning, really escalate really quickly. And to have a balance on there when you could pull it in, even if it's at the same rate or very similar, that's a priceless opportunity that should be taken advantage of for sure.
Great. So what are you, home equity rates, what are they running right now? Somebody just wants to, oh, I just want to get a home equity line of credit. I don't want to do a new mortgage or anything.
So we have a couple options. We have an interest only option, and those rates can, for the longest we go out on a teaser rate is 4 years, and that's at 3.25%, and that's an interest only payment. But Bank of Hawaii also has an unbelievably wonderful product that's called our fixed rate loan option. And you can fix that in for 25 years, whatever balance you draw at closing, you can fix for 25 years at 3.75 right now. Those have no points, no nothing. And if it's under a $250,000 line amount, there's no fees.
So why would somebody consider that versus a mortgage today at 2.85%, for instance? What situation would someone go with a home equity?
If it is a smaller amount and their mortgage balance on their first is larger, I would say that might be a reason. But other than that, I really think that the first mortgage would make sense, especially even if you're going to fix it in at the 25 years. Fixing something over 25 years is, again, going to be a slightly higher payment than if you were to have the opportunity to amortize it over 30 over a greater period of time. Or excuse me, at the lower rate.
So what I'm, because, I've been in the business over 30 years now, which is a scary thought, but anyway, so it seems like we've had all these different trends, ARMs, home equities, but it seems like the real trend now is going with the fixed year 30-year mortgages. It seems the thing to do.
I think because rates are so historically low. I mean, I've been in this industry, I'm not going to say how long, but I've been through a few cycles, and I've seen rates go up and down, and this is by far the lowest that I've seen them, obviously because of worldwide economic peril.
Absolutely.
I think that for anybody, you never know what the future will bring. If you have an opportunity to grab a rate that would historically only have been available possibly under the adjustable rates, it's a really great opportunity and hard to pass up.
Absolutely.
But every case is different, and that's why it's important that you speak with someone who knows what all the options are for you, who can guide you through, here's what it would look like in these different scenarios, here are the risks, here are the rewards. And I think that that's where you really need to have someone on the side who is an expert at their craft and who can really help guide you through that and make that best decision and listen to what your needs are.
Absolutely. And then what I've been seeing is, you get some people who, have great credit, great income, but of course, the cost of homes in Hawaii is a lot higher. What a home in East Oahu, for instance, probably a nice home's at least 1.8 million. So sometimes they don't have that 25, 30% down. So what are some of the creative things that you've seen that people have done, or they could speak to, somebody to help them through that process of being able to buy, but maybe they don't have that 25% down right now?
Mortgage insurance is always an option, but I think what is challenging is that mortgage insurance is very expensive. So when you don't have that, when you may not have the down payment, it may also be because you haven't had enough expendable income in order to save that amount. So the qualification becomes very tough. The best thing I've seen in those cases, other than getting gifts from family members to help them purchase and the mortgage insurance, is hopefully people may have another piece of property that maybe they're not ready to sell yet, and they're trying to move up into a nicer home for themselves, something more suitable. And we can always do an equity line against that property to grab the equity from that home without having them having to move out and sell first in order to put towards the other loan.
So you just mentioned something on gift funds. So can you, share that with everybody, what a gift fund would how they would help a young couple trying to get into their home right now?
I can tell you from personal experience, it's a wonderful thing. It is, it's unbelievably expensive here. And just even buying $1 million home and trying to have $200,000, who just has $200,000 laying around for their first?
Yeah.
Very few people. So gift funds are something that are allowable on owner occupant purchases from immediate family. So they gift you the funds and we just consider it as an asset of yours. They have to sign a gift letter that says that they don't require or expect any repayment for it and that it is a gift. And so that's something that they need to consider with their tax advisors as well. You know, I am, my rolling disclaimer, this woman is not an accountant. So I have to put that out there, you know, but I think that there are also ways of being creative and, you know, looking for options to try to mitigate those tax consequences as well for people gifting funds. But it's an amazing opportunity that allows people to actually get into a slightly higher price point. The other, for first-time home buyers, if they don't have that, another option without mortgage insurance is for Bank of Hawaii, which I know we're one of the very few, if not, yeah. We will do a stacked first and second mortgage in order to get you to 90% loan to value. So rather than on that $1 million home coming in with 200,000, just 100,000, not just, but 100,000 rather than the 200,000. And that would not require mortgage insurance. It doesn't cause an extra payment. It doesn't raise the pricing on, you know, your monthly payment. And that's a nice flexible option. And again, unlike a traditional equity line where, well, that's wonderful until your 3 or 4 year teaser runs out. We have a 25-year fixed product. You never have to worry about that escalating on you. It's very secure, just as secure as your first mortgage interest rate. And it's an amazing opportunity for people.
Well, I just think you know, I'm just so thankful and grateful that the banking industry has so much creativity right now, given how tough times are. You know, so there's always, as they say, a silver lining during this COVID period of, you know, what's something that's beneficial that we can get out of this period right now. Why don't we touch on the forbearance? You know, I've been asked about forbearance. You might want to explain what that is and what's going on with that, and what are some considerations people have to think of with forbearance.
So there has been a lot of discussion and a lot of confusion, I think, as well around forbearance. So what mortgage forbearance is, it is a way of deferring your mortgage payments if you are having difficulties making those payments. So you basically make no payments at all. You call your lender, you let them know that you've experienced a hardship, that you'd like your mortgage payments basically paused, which is great. So what they will do is they will not charge you. Some are 3 months, some are 6 months, depending on, you know, lender by lender. At the end of that period, you will have options on how to make those payments good. They do not, one misconception is that you just are forgiven those mortgage payments. That is absolutely not the case. It is also added to the end of your loan. What happens is you will have a payment plan at the end of that forbearance period in which you have to make your payments back. So you still make the exact same amount of payments over the life of your loan. You stay with the same amortization of your original loan. It's just you defer those payments to a later date. And it is good. A lot of people, I think, have done it not understanding that there are some consequences to it. From a lender's perspective, if you are going on forbearance, that means that you are unable to currently make your mortgage payments. Is absolutely going to affect your ability to borrow. If you went on forbearance and you have been continuing to make your mortgage payments, even though you have the option, then that's okay. But if you have not made your payments, there isn't going to be any lender who wants to come back and say, well, you haven't been able to make your payments, but we want to extend you some more credit. It is going to affect your ability to borrow. It goes on your credit report, although in the beginning there was a lot of misinformation saying it wouldn't reflect on your credit report. It does not reflect as a late payment, so it shouldn't affect your actual credit score, although I've heard mixed things about that. But it will be a notation on there that says forbearance. If we pull your credit, if you come in for a refinance and we see that you are on forbearance, we are going to ask you to prove that you have made all your payments in a timely fashion. If you have not, then we may not lend to you. There's a good possibility that you will be ineligible for lending because if, again, if you are not able to make your payments, extending more credit to you, it just doesn't seem like a prudent thing to do for you or for us.
Mm. So what you're saying is it's maybe one of the last things you should consider. You know, you should keep up those mortgage payments, especially in times if you want to refinance with the new rates and everything.
Yes, it is something you should only do if you truly need it. If you are truly experiencing a hardship, absolutely, it's a wonderful tool. Please take advantage of it. But some people are using it almost as, I think, as a kind of safety net. They're just putting those payments, keeping those payments just in case something happens. And while that's a very viable option, it does have, you know, potential consequences that you should be aware of before you decide if that's right for you. But if you are making, you know, having difficulty, you've lost your job, you don't have the same income, you can't make the payments, don't hesitate to do it. Just understand that you will have to show that you are paid back in full, or that you have made 3 payments after coming out of forbearance before you will be eligible for new financing.
Well, Brenda, I just want to thank you for this morning. I mean, just fabulous information, very concise, quick, to the point, you know, letting people think through some of these things. And this is solid information, and I truly appreciate your time this morning. And I wanted to let everyone know, thank you for watching us today. And we usually do photos of Honolulu every week from Marianne, but we'll just post those on our live video connection, because we've run out of time now, and in all respect, we try to keep 15 minutes for everyone's time. And I just want to wish everyone a wonderful weekend. And Brenda, thank you. That was fabulous. Really appreciate it.
Appreciate it.
Absolutely. Thanks.